Good morning, everyone. Welcome to this update for global stocks and commodities for the 18th of August. It was another volatile week, and all the alarmists came out of the woodwork again, had a great week. And the net result, though, after a lot of volatility, was the market was only down a little bit in the US. The Australian ASX 200 didn't fare as well, but we'll see a bit of a rebound on Monday. And in any case, the Australian index had outperformed the US quite considerably over the previous month or so. So that was really just a bit of a return to normal. So the alarmists ended up being wrong again, as they have been over and over and over again for the last 4 or 5 years. Yet the market seems to respond in a similar fashion, and I guess that's just human nature doing what it's always going to do. So we're going to take a look at that in this particular edition, and the trigger has been, it's rolled around from being the trade war to something to do with a geopolitical risk. Then it was currency last week. This week it's yield inversion. But you know what? The yield inverted on the 2-year and the 10-year spread. It inverted for just 2 hours, and then it went back to where it was. So, this is a whole lot of stuff about nothing, really. We'll have the normal commodity and stock update. And in Portfolio Analyst last week, there was a couple of really important concepts addressed. One is that money's always going to flow where it's treated best. And in particular, I was looking at the bond market, which is really behaving in a completely unusual and different manner. And I'll touch on that a little in this edition. And we also looked at the gold sector as well, obviously, because gold is clearly the outperforming stock part of the market at the moment. I just want to look at this issue of US market value because, last week when we get a bit of a plunge in the market and the alarmists come out and they want to point, they pull out the statistics that suit their particular argument to say that, well, because the US market is overvalued, it's got to fall a long way and it's got to be a bear market because of value. Well, it's just not the case. Ultimately, markets are driven by earnings and they're driven by valuation relative to other investment avenues. So that's bonds, that's fixed interest, that's property. Money is always looking for the best home that it can find, and that's never going to change. And in my view, the US market is still not overvalued. And if we look at some actual statistics, so these are the actual numbers. The consensus earnings estimate for 2020 for the US market, for the S&P, is $178. So that's a composite number that's published every single day of the week. The 10-year bond yield in America is yielding 1.5%. The S&P earnings yield, so if you divide the 178 and reverse that or invert it and express it as an earnings yield, then it's actually 6.1%. And even if you look at the dividend yield, and American companies don't traditionally pay high dividends like Australian stocks do because investors get rewarded by share price appreciation because of buybacks and things. It's just a different way of going about it. So the dividend yield is 1.9%. So that in itself is 30% higher than the 10-year bond yield. But the earnings yield is 6%. So you just got to ask yourself, where would you want to put your money? So the market is not overvalued from a comparative return basis compared to the bond market. And all the other stuff about the trade war and currencies and yield inversions is just a distraction, and you're really best served to ignore it. The US consumer is 70% of the US economy, and the US consumer is doing just fine, thank you very much. And the consumer in China is also, whilst it has gone down a little bit, it's gone down from a fairly robust level to a slightly less robust level. But if you look at the results of Alibaba that came out through the week, and they were sensational. So there's nothing wrong with the Chinese consumer either. And the Chinese economy is in transition from being an export-led economy to a consumer-driven economy. So you know, they're all positive signs for both the US and China. Let's look at American stocks. The S&P fell just 20 points in the end, 0.5%. Trade tensions have been keeping the market pretty close to the edge, so the market is very nervous, and I suspect that that's probably going to continue because these trade issues aren't going to go away. And last week it was the devaluation of the yuan that tipped the market into a bit of panic. Last week it was the yield curve inversion, which, let's be honest, only lasted 2 hours and ended up back where it was. So, you know, this is all just a lot of noise. And the bigger picture is that it's never a top in the market when sentiment is as bad as this. Bullish sentiment is getting towards an extreme low, and bearish sentiment is getting towards an extreme high. And a study that I saw this morning showed that when that happens, 80% of the time the US market is significantly higher in the following 12 months. So we don't tend to see tops when sentiment is as it is at the moment. Technically, as we'll see in the chart in a minute, the S&P is in an area that's undecided. It's between the 50 and the 200-day moving averages, and that means that you know, you can't really be terribly confident in either direction at the moment. The US dollar definitely finished higher, so let's just take a quick look at the charts. So there's the S&P. So the blue line is the 50-day moving average. The red line is the 200-day. The 200-day has been essentially flat since October of last year, but at least it hasn't rolled over, and it's still mildly up, and the price is above it. And also the 50-day is above the 200-day, and it's widening. That gap is widening. Now, I would prefer to see the S&P index above the 50-day. That would be ideal, but we're just going through a period of consolidation, and you can see there's been a lot of noise over the last 2 weeks from the factors that I've indicated, but that's just computer algorithms just kicking in and running with the headlines. And you know, we're getting a couple of days down, but then the market just bounces back again. So I don't see that anything very much has changed in the US market. Let me just go back to the slides. So just looking at this question of yield inversion, because that was the trigger for last week. Yeah, okay, the 10-year and the 2-year, which is the most important comparison or spread, and that was the only spread that hadn't inverted. Well, it did, but that, as I said, that only lasted 2 hours. The question I want to look at, and I did address this in Portfolio Analyst last week, is that normally yield inversions point to a looming recession in the next 1 to 2 years, and the stock market at some point will start to adjust for that. So stocks start to price that in, but it's also a matter of fact that stocks, once you get the first yield inversion, that stocks can often go up for 1 to 2 years before they peak. So even if this was a recession, and I don't believe that that's what the bond market is pointing to, and I'll explain that in a minute, you know, there still could be considerable upside in stocks yet, even if there is a recession coming within that time period. But there's every chance that this time the bond market is signaling something for a different reason, and it's not actually signaling a recession. and it's the fact is this, or the possibility is this, that bonds are being bought for capital gain reasons, not for yield reasons. Now, this has been going on for some time, and normally the bond market exists as a place where investors put their money. They know if they're buying quality government bonds that they'll get their money back, and they'll get whatever the interest rate is. So it's pretty much a guaranteed capital gain. But the problem now is that so many bonds are now zero or negative that investors have got to go elsewhere. They either go into the stock market, where they obviously don't have capital return guarantee, or they do something different with the bond market, which is certainly what's happening at the moment. So low rates in the bond market and yield inversions are not necessarily a sign of economic weakness, which is what the normal signal will be. And of course, the reason that it's different this time is that central bank policy over the last 5 to 10 years is something that's never ever been seen before. And so it's changing the way that investors hunt for a return. It's actually changed the market psychology. And so a lot of investors are buying bonds because they know that central banks are going to be buying bonds. And so therefore, whatever price they pay for a bond, it doesn't matter because the central bank is going to come in behind them and push the price up even further. And so it is seen as basically a no risk trade. Now, of course, it's not. And if something changes that, then the bond market could fall quite sharply if there's an uptick in inflation. But I think this is the important thing. The reason that I bring this out, and I know that a lot of people aren't interested or knowledgeable on the bond market, but the key thing here is that if you are reading stuff that is telling you that the bond inversion is going to give us a recession, which means stocks are now, it's all over, the bull market is all over and we're heading for a bear market, then you've just got to remember this slant on it, that maybe the bond market is sending us a different signal for a different reason this time. And so again, just relax about your stocks. It may not be as the media is portraying it. That's the point that I want to make. And of course, we've now got $15 trillion of negatively yielding debt around the world. So it's entirely possible that that the norms of the past no longer apply because we've never been in this situation before. All right, enough of that. Aussie stocks, our dollar was steady at 67.83, which is a bit unexpected given that the US dollar did go up and went up reasonably strongly. Our index fell another 179 points, so very similar. So that's two back-to-back 2.7% down weeks. But really the Australian market had gone up more than the US and other global markets. We'll probably see a rebound here on Monday, but we're also seeing earnings season is adding to the volatility. We've had some good results, but we've also had quite a few quite disappointing results and some very disappointing outlooks as well. So certainly our market is not out of the woods at all. All right, let's just check on the US dollar. So the US dollar was pretty much one-way traffic. It was up all the way last week, but the Australian dollar bounced around a little bit, but really didn't change in the end. And the ASX 200, there's the second sharp week of down, with Thursday being particularly nasty. But we're also in a situation in the Australian market where we are between the main moving averages. In this case, the 150 and the 50. So that's where the Australian market is at the moment. Now turning to gold. This is gold on a daily basis. So we managed to. It was a bit volatile. You can see here on Tuesday we had a low of 1480 and a high of 1535. That's a hugely volatile week, and it was one of the biggest weeks in terms of range that we'd seen since the 1st of August. But as opposed to that week, which was basically up the whole week, this was all over the shop. And it's no real surprise because gold has had such a strong move and it's so far above the 50-day moving average that you would expect to see a bit of volatility. But nevertheless, we didn't get a pullback. It still just continued to move sequentially higher throughout the week. And if we look at it on a weekly chart, you can see that gold has broken out quite clearly. We've now blasted through the 50-day, through the 50% retracement. So if we take this retracement from the top in 2011 all the way to the bottom at the end of 2015, we just went straight through the 50% without stopping whereas previously this 38.2 had put a cap on the market quite strongly, and now we're heading to the next level, which is 1581. And you'd be a very brave person to say that that we could not get there very, very quickly, because that's an extremely strong trend. Let's look at GDX. So there's GDX on a weekly. Now, stocks were down a little bit, and we often see stocks leading the underlying metal. In fact, that's a more reliable indicator. So, the fact that stocks were down may indicate we might get a bit of a pause. We might just get some consolidation for a couple of weeks, maybe even a little pullback in gold for a couple of weeks. But clearly the trend is very, very much to the upside. So just to wrap it up, gold up $16, and we had a peak at 15.35. Now that's pushed the Australian dollar gold price up to 22.36. So how profitable are the local gold miners? And as I said, GDX took a bit of a breather last week. Other commodities, copper was down slightly to 258, but really not much change over the last few weeks. But I will look at the copper inventories, which I haven't looked at for a couple of weeks, and there's been quite a change there. And crude oil was up slightly, just under $55. Another volatile week for crude. So there's the 6-month copper chart. Hasn't really changed very much, but certainly the inventories have. So I guess the copper price fell at the end of July, I guess in anticipation of what would be perceived as a change in the inventory levels. So you can see there's the 1-year level has moved up quite a lot. We've gone from 120,000 tonnes, and now we're up close to 300,000 tonnes in the London Metals Exchange warehouse. So that is certainly a relatively reliable indicator of economic growth. So that's not a great sign as far as world economic growth goes. And if we expand it out again, just to put a bit more perspective, this is the 5-year. You can see we've moved from basically 5-year lows back towards, we're now back in the top half of the inventory levels. So it's no wonder that the copper price is struggling, and that copper miners are looking pretty weak at the moment. There's the crude oil chart, not a lot of change in the week. So to wrap it up, you've got a choice. You can either be positive to what's going on in the market, or you can be negative. You can be led by the media. I know which one I choose, and I know which one has been the more productive over the last 5 years. This is the second 5% dip we've had this year. Normally, the normal level is 4, but it obviously does move around quite a bit. But yeah, we've only had 2 5% dips this year, so we're running pretty much according to what you would expect. So from my perspective, taking the positive slant on it, which I believe is certainly backed up by both the statistics and by the market action, then dips remain a buying opportunity until proven otherwise. And I think that's the only way that you should be looking at it. To take a negative view is assuming that something will happen that currently isn't happening. And that is just illogical from my perspective. So for me, dips remain the buying opportunity. It's really important, though, to have a clear, simple game plan, and then be able to stick to it, have the courage to stick to it. So they're the 2 keys, and they're the things that most people struggle with. Now, Portfolio Analyst this week, I'm going to be taking a bit of a look at the ETF market, and also a bit more on the gold sector as well, because that's obviously where the greatest momentum exists at the moment. And of course, as always, we've got a 10-bagger portfolio which is under construction and certainly is monitored fairly closely. And that's all heading in the right direction, despite all the volatility that we've had. That's moving along quite nicely. So that's it for this week. There's my contact details for any non-members, and I'll be back with you next weekend. Cheers.